Apple, founded by Steve Jobs in 1976, a company that with its tech innovations changed the world forever. And although they're responsible for this, they still make us look cool with the AirPods. Apple is one of the biggest companies in the world with die-hard fans, waiting in line for hours and some even days, just to be the first to experience Apple's newest products. But does this make Apple stock a buy? In this video, based on a Morningstar report, we're going to look at Apple's business strategy, economic moat, risks and uncertainty, stewardship, and profit drivers. Now, without further ado, let's get right into this video. But before we begin, if you want to make money in the stock market, do yourself a favor and smash the like button for the YouTube algorithm, subscribe to our channel, and hit the notifications bell. Now, let's talk Apple stock. Part 1. Business strategy and outlook. Apple's competitive advantage stems from its ability to package hardware, software, services, and third-party applications into sleek, intuitive, and appealing devices. This expertise enables the firm to capture a premium on its hardware, unlike most of its peers. Despite its admirable reputation, loyal customer base, and unique products, the consumer hardware space can be unforgiving to firms unable to consistently satiate the customer's appetite for more features. Given the short product cycles of Apple's products and army of firms targeting its dominance, analysts do not believe Apple has a wide economic moat. Switching costs and intangible assets support Apple's narrow moat. The firm enjoys stellar returns on its devices by offering a unique user experience with its iOS ecosystem. Contrary to its peers in PCs and smartphones that rely on open operating systems, Windows and Android respectively, Apple's walled garden approach for its popular iOS allows it to charge a premium for relatively commoditized hardware not too different from that sold by Samsung, Dell, and others. Customer switching costs are elevated for Apple users, as a non-Apple iOS experience does not exist, unlike computing platforms for the Windows or Android ecosystems that boast PCs and smartphones from a multitude of firms. Analysts view the iPhone as a revolutionary product that created the smartphone ecosystem and transitioned computing habits away from the PC. The robust App Store helped foster iPhone adoption and grow Apple's user base, with applications ranging from productivity, social media, gaming, music, and so on. Analysts foresee Apple's ongoing business coming from existing customers versus new smartphone adopters. With hardware becoming increasingly commoditized and replacement cycles potentially elongating in the long term, analysts expect Apple to focus on newer software and services to augment the user experience and retain customers. The firm's additional products and services, such as Apple Watch, iCloud, Apple TV+, AirPods, Apple Pay, act as both supplemental revenue opportunities and, more importantly, critical enhancements to the iOS ecosystem that support Apple's crown jewel, the iPhone. Now, let's analyze economic moat. Analysts assign a narrow economic moat rating for Apple that stems from the combination of switching costs and intangible assets. The firm's primary moat source is customer switching costs, as Apple bolsters the user experience with a cohort of auxiliary products, such as iPad, Apple TV, Apple Watch, AirPods, and so on, and services that augment Apple's sphere of influence on the consumer. As current iPhone users are familiar with the iOS environment, it may take multiple subpar product releases to warrant an exodus to an Android OS, as these customers are likely loath to leave Apple's seemingly superior walled garden. Regarding intangible assets, Apple's differentiated user experience via iOS, coupled with its expertise in both hardware and software design, allows the firm to more seamlessly build integrated products. We see no other technology titan with comparable expertise in both hardware and software. In turn, analysts believe this integration allows Apple to build industry-leading devices that command industry-leading average selling prices, most notably the firm's crown jewel, the iPhone. Recent survey data shows that iPhone customers are not even contemplating switching brands today. In a December 2018 survey by Kantar, 90% of US-based iPhone users said they plan to remain loyal to future Apple devices. A recent survey as of October 2020 from 451 Research indicates iPhone customer satisfaction of 98% for iPhone 11, 11 Pro, and 11 Pro Max combined. Also, users of ancillary products, especially the Watch and AirPods, lose significant functionality when paired with a smartphone other than the iPhone. Ultimately, we believe that existing iPhone users are relatively locked into the iOS ecosystem and interface, while the Android cohort has attempted to replicate a similar feel of apps, app stores, and integrated experience. The fragmentation of its key players will likely prevent many loyal iOS users from switching, at least over a few product cycles. Competitors such as Samsung and Google specialize in hardware and software respectively, with Samsung boasting leadership in mobile device units, and Google's Android OS serving as the pervasive smartphone OS. Although Apple's low double-digit market share in the smartphone space doesn't seem excessive, the firm does enjoy the lion's share of industry profits. Neither Samsung nor Google has been able to offer a comprehensive and integrated product like the iPhone, though both have attempted to develop operating systems and hardware with mixed results. Apple's expertise in both hardware and software represents an intangible asset that even the strongest of tech firms have struggled to replicate. Although Apple's brand tends to be associated with premium technology gadgets, analysts don't think it can support an economic moat in isolation. Specifically, Apple's brand strength is a consequence of its differentiated hardware and software design, not the cause. Analysts don't think Apple can charge twice the price of a similar set of hardware solely by sticking an Apple logo on it. Similarly, analysts suspect that Apple's brand equity will wane if the firm's products were technologically inferior to competitors over an extended period of time. As evidence, Nokia was the 8th most valuable brand in the world as recently as 2010, according to Interbrand, before succumbing to the rise of the smartphone. The active installed base of Apple devices reached 1.5 billion at the end of 2019, up from 1.4 billion a year prior, showing the strong stickiness Apple has created. However, these switching costs are not insurmountable, illustrated by the rise and fall of former mobile device titans such as Nokia, Motorola, and BlackBerry, all of which failed to keep up with smartphone innovation. The short product cycles for phones and the inability of these firms to sufficiently innovate left each one struggling after the debut of Apple's iPhone and its subsequent proliferation. Apple is not immune to these pitfalls, as consumer sentiment for technology gadgets can be unforgiving, with one buggy or subpar product potentially driving customers to other companies' offerings, which have been increasingly competitive. We have often seen innovative features arise in the Android ecosystem before Apple, such as OLED screens and 3D Sense. These industry dynamics prevent us from assigning a wide moat rating for Apple. At this point, analysts do not consider network effects to be a key source of Apple's moat. Apple's iOS users gravitate to the App Store to purchase new applications, and the size of Apple's installed base attracts developers to build new apps for iOS. Apple's integration of hardware and software also supports its developer networks, as Apple knows that iOS will be loaded on to only a handful of screen sizes or iPhone models, versus the hundreds of devices and manufacturers that support Android. This leads to a more fragmented Android ecosystem, which is relatively harder for developers to support. Apple consistently touts when the majority of its user base is on the largest operating system, which in turn allows developers to build for the latest version of iOS and know that their apps are optimized for most of Apple's user base. Nonetheless, the Google Play Store that supports the Android user base also achieves a similar network effect. Ultimately, the hardware and software are the key differentiators for Apple's moat sources, since the lion's share of applications used by smartphone users are platform agnostic in our view. Even for apps built for iOS first before Android, mobile apps are ultimately built for both platforms in short order. Finally, Apple may boast some cost advantages associated with its supply chain, such as pressuring suppliers or making massive purchases of memory, flash storage, and other key components. However, these advantages are predicated on the immense forecast volume of Apple's products, and we surmise these advantages would evaporate if Apple's device production were to diminish. Apple likely could not build the lowest cost phone in the industry, as it has to build iOS rather than use Android for free. More important, this is likely a moot point, as we think Apple will play at the high end of the market with best-of-breed components for the foreseeable future. It's been doing so with the Mac for 40 years and counting. Now, let's talk about risk and uncertainty. As one of the largest firms in the world, Apple is susceptible to competitive threats from capable competitors with significant resources. Over the course of its iPhone-fueled decade of dominance, Samsung, Microsoft, Google, and others have taken their best shots at Apple with fleeting success. Consumer hardware is inherently prone to cutthroat competition, as short product cycles and customers hungry for greater features make market leadership difficult to sustain. Although Apple has done well with its walled garden approach with iOS, the firm competes with Chinese OEMs at the low and mid-tier, as well as tech titans such as Samsung across the entire spectrum of smartphones. Furthermore, analysts Analysts suspect that many customers are holding onto their phones longer as premium devices are more than good enough for today's needs and potentially tomorrow's. Analogous to the decline of PCs, Apple faces the possibility of smartphone unit stagnation or even declines once emerging markets saturate or consumers gravitate to mid-tier devices. Should it be unable to innovate, the firm may lose its ability to charge premium prices for hardware that is no longer indistinguishable from many comparable devices. Some competitors are willing to sell hardware at essentially cost to drive revenue or stickiness in other business segments. A notable example is Amazon with its multitude of products, including its Echo smart speaker, Fire TV, Prime Music, Kindle Fire, and Prime Video to attract and retain Prime customers. If these devices supersede their iOS counterparts, Apple's devices may be at risk. A recent focus on AI assistants such as Google Now and Amazon Alexa has also put pressure on Apple Siri that has fallen behind its peers in efficacy. This is another area Apple may face headwinds if consumers further prioritize voice recognition capabilities. Now, on to the next part, which is stewardship. Analysts view Apple's stewardship rating as standard. Tim Cook became CEO in August 2011 after co-founder, longtime CEO, and visionary Steve Jobs stepped down from the CEO role before passing away in October 2011. Cook was considered Jobs' right-hand man and served in various operations roles with Apple before becoming COO in 2005. Although Jobs' death was a blow to the firm, as he was a one-of-a-kind leader and creative mind, Apple is not lacking in creative leaders. Arthur Levinson, former chairman and CEO of Genentech, is chairman of Apple's board of directors. Jeff Williams serves as COO of Apple and would be the best bet to replace Cook as CEO. Analysts think Apple's recent level of technological innovation has been adequate, though it has likely faced an unreasonably high bar for expectations after the debut of the iPhone. Many of the firm's recent innovations have been in software and services within iOS, such as Apple Pay, as well as under-the-hood improvements in semiconductors, rather than revolutionary ubiquitous devices like the iPod or iPhone. Analysts like how the firm designs its own chips for the CPU and artificial intelligence, as this can create a better user experience, since Apple also designs the operating system and can appropriately tailor the CPU or neural engine to its needs. Going forward, analysts expect the firm to also design its own GPU, which should enable performance differentiation. Products like the Apple Watch, Apple TV, AirPods, and HomePod don't move the needle in isolation, but should drive incremental earnings growth to Apple. More importantly, these products will make it more challenging for iPhone users to leave the iOS ecosystem. Although the Apple Watch has had mixed results at the outset, it is not a miss just yet, given similar slow starts for the iPad and iPhone. Although Apple maintains sterling brand recognition and has over 1.5 billion active devices, it has made a few missteps under Cook that skeptics would argue wouldn't have happened under Jobs. Apple made a poor decision to part ways with Google Maps in iOS 6 and launch Apple Maps, with a bevy of bugs and errors, leading to a formal apology. More recently, Apple is being investigated by the US government, as the firm purposefully slowed down iOS on older devices. While the firm claims that it was to protect the user from sudden phone shutdowns, many fear that Apple was implementing planned obsolescence of their devices in order to get customers to upgrade. In terms of capital allocation, analysts applaud Cook's decision to initiate dividend and stock buyback programs, as well as take on debt in order to fund such programs, when most of its cash was trapped overseas. As of September 2020, Apple was authorized to purchase up to $225 billion of stock through its share repurchase program, of which $168.6 billion had been utilized. Apple continues to strive to achieve a net cash neutral position over time. Perhaps more important, Apple's frugality in terms of acquisitions is quite admirable. Apple's strategy of focusing on smaller tuck-in deals and developing products in-house, rather than splashy but questionable deals, like Microsoft's purchase of Skype or Google's foray into hardware by acquiring Motorola Mobility and Nest, appears to have served investors quite well in recent years. Even Apple's $3 billion acquisition of Beats Music and Beats Electronics represented only a tiny portion of the firm's total cash balance. Apple has also done a good job of attracting top-notch talent to the company, such as former Burberry CEO Angela Ahrendts, to run Apple's retail and online stores. However, Ahrendts recently stepped down, with head of HR Deirdre O'Brien taking over the role. These hires have strengthened Apple's bench in the unlikely event of Cook departing the company, and each hire likely has aided in Apple's efforts to build and deliver the Apple Watch, and perhaps future products as well. All the while, Apple's ongoing operations continue to generate operating margins and cash flow well above its peers in various hardware industries, which bodes well for future free cash flow for investors. In July 2019, Intel announced it agreed to sell its 5G smartphone modem business to Apple for $1 billion. This is the second largest acquisition by Apple. Analysts had been expecting this deal since Intel announced its plans to exit the 5G modem business, following the resolution of the dispute between Apple and Qualcomm earlier in 2019. Analysts believe this deal validates Apple's strategy of trying to bring as much chip development in-house as feasible, though we don't expect the firm to replace Qualcomm's 5G modems in future iPhones for at least a few years. Now, profit drivers. Analysts expect total revenue to be up 11%. Thanks to strength in Mac and iPad sales related to work and learning from home trends, and the 5G iPhone 12 launch. Analysts expect services to grow at 10% CAGR over the next 5 years, while wearables also maintains strong double-digit growth. Following a strong growth year in fiscal 2021, iPhone sales will record modest growth, with double-digit services growth driving total revenue growth in the mid-single digits. Analysts expect gross margins to remain in the high 30s, thanks to Apple's exceptional premium pricing strategy and stable iPhone margins. The firm recently began disclosing product and services gross margins, and we anticipate product gross margins tracking in the low 30s, and services gross margins hovering around 65%. Although analysts think the higher margin services segment will grow nicely, they foresee lower margin other products, such as the Apple Watch, serving as an offset. However, these other products remain vital to Apple being able to lock in iPhone customers with the likes of AirPods, watches, and other accessories that sell at a notable premium to non-Apple counterparts. The shift to internally designed ARM-based chips in lieu of chips from Intel for Apple's Mac PCs should help improve Mac margins. To remain king of the hill in the premium smartphone market, analysts model higher research and spending as Apple drives innovation and potentially ventures into new frontiers. Analysts expect operating margins to remain in the mid-20s. Well, that's it for today's video. Will you invest in Apple stock? Let us know in the comments down below. Also, make sure to smash that like button and subscribe to our channel. Stay bullish.